Here's something that happened quietly, and most people completely missed it. Right now, buried inside the legal definition of your savings account, there is a clause. It has been there for decades. Most depositors have never read it, most bank employees will not volunteer it, and the mainstream financial media will not explain it because it does not fit the narrative they are paid to maintain. That clause gives your bank the legal right to delay your withdrawal by 7 days. Not freeze it permanently, not block it forever, but delay it. 7 days, without giving you a reason, without triggering any crisis headline, without any public announcement whatsoever. This is not rumor, this is not speculation. It is codified in the Code of Federal Regulations under Title 12, Part 204, Regulation D, which governs savings deposits at every bank, every credit union, and every thrift institution in the United States. The clause reads that a depository institution reserves the right at any time to require 7 days advance written notice of an intended withdrawal from a savings deposit. Those are the actual words. Most people never encounter them because they never read the fine print they sign when opening an account. But the clause exists, it is currently operative, and it was not written there by accident. What that clause represents is not just a technicality, it is a pressure valve. A mechanism that exists precisely because the people who designed the banking system knew that someday, under the right conditions of financial stress, they would need a tool that could slow a bleeding without requiring a formal emergency declaration, a tool that operates below the threshold of public visibility, a tool that buys time. What I'm going to walk you through today is not a crash, it is not a panic, and it is not a rumor. It is a sequence. A quiet procedural sequence that begins with a legal framework most depositors do not know exists, builds through the specific financial stress that is accumulating on bank balance sheets right now, and ends at a place where the decision of whether you can access your own money is no longer entirely yours to make. I have spent years watching these sequences unfold. The names change, the triggering events change, the headlines change, but the mechanics do not. And once you understand the mechanics, you stop waiting for a headline to tell you something has started. Because by the time the headline arrives, the first 3 moves of the sequence have already happened. Let me establish the historical foundation, because you cannot understand where we are without understanding where this architecture came from and why it was built the way it was. The year is 1933. The United States banking system has been collapsing for 3 years. Between 1930 and 1933, over 9,000 banks fail. 9,000. Not weakened, not bailed out, not restructured, failed, gone. The savings of millions of Americans evaporated, not because they spent the money, not because they made bad investments, but because the institution holding their deposits ran out of liquid funds to honor withdrawal requests. The money was there on paper. It was not there in cash. And once other depositors figured out that the bank could not pay everyone at once, the run began, and the run guaranteed the outcome it feared. What followed was a fundamental redesign of the relationship between depositors and the banking system. The Federal Deposit Insurance Corporation was created, deposit insurance was introduced, reserve requirements were restructured, and embedded into the very definitions governing what a savings account legally is, regulators wrote in a reservation of rights for banks. The right to require advance notice before releasing funds. Not a permanent right to refuse, a temporary right to delay. A valve. For most of the following 9 decades, that valve was never needed because the system was operating within its design parameters. Runs happened at individual institutions but were contained quickly. The FDIC would step in, make insured depositors whole over a weekend, and the system would continue. The valve was a redundancy, like a fire suppression system in a building that has never had a fire. You stop noticing it is there. But then, the savings and loan crisis arrived in the 1980s, and what it revealed was that the architecture built after the Great Depression had a gap. It could handle individual bank failures. It could not easily handle systemic failures across an entire sector of the banking industry. Between 1986 and 1995, over 1,000 savings and loan institutions failed in the United States. The Resolution Trust Corporation was created specifically to manage that wreckage. Taxpayers absorbed over $120 billion in losses, and regulators began designing a more permanent answer to the question of what happens when the crisis is too large for the insurance fund alone. That answer arrived in full after 2008, and this is where the story becomes directly relevant to the money you have sitting in a savings account right now. After the global financial crisis, the Financial Stability Board, which is the international body that coordinates financial regulation for the G20, published a new framework for resolving failing banks. The core principle of this framework was that the cost of a bank failure should be borne primarily by the bank's own stakeholders, not by taxpayers. The framework is called bail-in as opposed to bailout. In the United States, it is embedded in Title II of the Dodd-Frank Act under what is called Orderly Liquidation Authority. In the European Union, it is the Bank Recovery and Resolution Directive. In the United Kingdom, it is the Banking Act of 2009. In Australia, Canada, and across the G20, variations of this same framework are now law. The the Financial Stability Board coordinates its implementation across 24 jurisdictions worldwide. Here is the specific mechanism. When a systemically important financial institution enters a resolution process, the FDIC or equivalent regulator takes control. Shareholders are wiped out first. Then junior bondholders take losses. Then senior unsecured bondholders. And then, if additional capital is needed to make the institution viable again, uninsured deposits above the insured threshold can be converted into equity. Not withdrawn, not returned, converted. You become a shareholder in a recapitalized version of the institution that just failed. Your claim on cash becomes a claim on equity in a restructured bank that may take years to fully resolve and may return cents on the dollar. This was tested in the real world in March 2013. Cyprus. The two largest banks in the country, Bank of Cyprus and Laiki Bank, were restructured under a process coordinated by the European Central Bank and the International Monetary Fund. Depositors with balances above 100,000 euros lost up to 47.5% of their savings. Those funds were converted into bank equity. The banks reopened on a Monday. Depositors who had been customers their entire lives discovered that the rules they thought governed their money had been rewritten over a weekend. The Financial Stability Board's documentation from the period following Cyprus described what happened as a successful proof of concept for the bail-in framework. Those words are in their published record. Not hidden, not classified, published. The template was formally codified, the framework was expanded, and the legal architecture that allows depositor funds to be converted into equity during a bank resolution now governs every major Western economy on the planet. Now let me explain what this has to do with where we are in early 2026, because the conditions that make this architecture go from theoretical to operational are not hypothetical projections. They are currently sitting on bank balance sheets across the United States, and the data is public. As of the end of 2024, according to data published by the Office of Financial Research, aggregate unrealized securities losses across all FDIC-insured banks in the United States stood at $481 billion. That number represents approximately 19.9% of the aggregate equity held at banking subsidiaries nationwide. Nearly one-fifth of the entire capital cushion that is supposed to absorb losses in the banking system is sitting in paper losses that do not appear on income statements because the assets are designated as held to maturity and therefore do not need to be marked to market unless they are sold. By the spring of 2025, as reported by Fortune, that number was approaching $500 billion as the 10-year Treasury yield rose again in response to renewed inflation pressure and the uncertainty introduced by the tariff environment. A Stanford finance professor who has served as an expert in systemic banking risk told Fortune directly that at a 10-year yield above 4.5%, the banking system starts seeing serious problems. At 5%, it becomes quite bad. As of this recording, the 10-year yield is in exactly that zone. This matters because of what happened at Silicon Valley Bank in March 2023, and more importantly because of what SVB revealed about the structural vulnerability shared by hundreds of institutions operating within the same architecture. SVB was not a rogue institution. It was doing what hundreds of regional banks were doing during the zero-rate era. It was buying long-duration Treasury securities and mortgage-backed securities to earn yield on deposits that were growing faster than loan demand. When interest rates rose sharply in 2022, the market value of those securities fell. The losses were unrealized. They were disclosed in balance sheet footnotes that most depositors never read. But when confidence eroded and depositors with large uninsured balances began moving funds, SVB was forced to sell securities to meet the outflows. The moment it sold, the paper losses became real losses. The real losses destroyed the capital cushion. The regulators arrived on a Friday. By Monday, the bank had ceased to exist. The Office of Financial Research published a brief in May of 2025 that stated the implication precisely. Unrealized losses could increase banks' vulnerability if other developments, such as a large surge in commercial real estate loan losses, make depositors question a bank's viability. That is not a theoretical construction. It is a description of what is actively building in the commercial real estate sector right now, which happens to be the segment most concentrated in the loan books of regional and community banks. Commercial real estate delinquency rates for office loans in the United States reached 10.4% in the second half of 2025, approaching the 2008 peak and representing the fastest rate of increase in this data series on record. Regional banks hold approximately 44% of their total loan books in commercial real estate, compared to 13% at the largest banks. New loan-level research published in late 2025 found that latent distress in commercial real estate, meaning loans that would be underwater at today's property values even if they are not yet formally delinquent, is approximately 4 times larger than what current delinquency statistics imply. The banks are not recognizing these losses yet. Extend and pretend the practice of modifying loan terms and pushing out maturity dates to avoid formal default recognition is masking the scale. Over $1 trillion in commercial real estate loans were scheduled to mature by the end of 2025. The maturity pressure extends through 2026 and 2027. When those loans mature, the borrower either pays off the balance, refinances at current rates, or defaults. There is no fourth option. Refinancing at 6 to 8% on a property that has declined 30 to 40% in value is not economically viable for most commercial borrowers. The extend and pretend window has a hard limit, and when it closes, losses that have been building for 3 years will need to be recognized. Here's what that recognition event looks like from a depositor's perspective, walking through the sequence step by step, because the order of events is as important as the events themselves. A regional bank with concentrated commercial real estate exposure begins reporting elevated loan loss provisions. This appears in its quarterly earnings. The investment community flags it as a credit quality concern. An analyst publishes a note. A local financial journalist picks up the story. Within 24 to 48 hours, depositors holding uninsured balances above $250,000 begin calling the bank. Some begin moving funds. The bank's overnight funding position starts deteriorating. The bank's treasury team activates its liquidity contingency plan and begins drawing on Federal Home Loan Bank advances to pad its short-term cash position. One of the tools in that contingency plan is the 7-day notice clause. The bank does not need a regulatory order to use it. It does not need to declare an emergency. It does not need to make a public announcement. It activates a right that has existed in its deposit agreements since the accounts were opened. Customers receive a written notice. Withdrawals are delayed. The bank has bought itself 7 days to source alternative funding, to negotiate with regulators, to explore a sale or merger, or to prepare for a formal FDIC resolution process. From the depositor's side, the notice is the first visible signal that something is wrong. But the bank's balance sheet stress did not begin the day the notice arrived. It began months or years earlier, building through unrealized losses, deteriorating commercial real estate performance, and compressed lending margins. The notice is not the beginning of the problem. It is the moment the problem becomes impossible to manage in private. Let me now be precise about what the FDIC's actual capacity is in this scenario, because there is a widespread assumption that the insurance fund provides a complete backstop, and that assumption does not survive contact with the actual numbers. The Deposit Insurance Fund held a balance of $150 billion as of the third quarter of 2025, representing a reserve ratio of 1.40%. That means the fund covers 1.40 cents for every $100 of insured deposits in the United States banking system. Total insured deposits are measured in the low tens of trillions. The fund is sized to handle individual bank failures. It is not sized to handle a simultaneous stress event across multiple institutions in the same sector. The FDIC has been transparent about this constraint in its published documentation. The Orderly Liquidation Authority exists precisely because the fund alone cannot address a systemic scenario. In that scenario, the resolution process relies on the bail-in mechanism to recapitalize failing institutions using the institution's own liability structure, including uninsured deposits, rather than drawing down the fund. That is why the framework exists. It is the FDIC's institutional answer to the question of what happens when the insurance pool is not large enough. And the answer is that uninsured depositors become part of the recapitalization. Now let me connect this to the actual mechanics of what you have sitting in a savings account, because the gap between how most depositors think about their balance and how the legal system categorizes it is worth understanding clearly. When you deposit money at a bank, you are not placing your money in a vault for safekeeping. You are making an unsecured loan to the bank. The bank takes your deposit, records it as a liability on its balance sheet, and deploys those funds into loans and securities. You become an unsecured creditor of the institution. You have a claim against it for repayment. That claim is subject to the terms of the account agreement, to applicable regulations, and in a resolution scenario to the priority hierarchy established under federal law. For balances above $250,000 per depositor per institution, there is no insurance backstop. You are an unsecured creditor. In an orderly liquidation proceeding, your claim ranks below the bank's derivative obligations, below secured debt, and alongside other uninsured depositors in a recovery process whose timeline and outcome are determined by the FDIC as receiver, not by you. Most people do not think about their savings account this way because they have never had to. The question this video is asking is how much longer that remains true. The pattern that connects 1933 to the 1980 savings and loan crisis to 2008 to the regional bank stress of 2023 to the current environment is consistent across all of them. Debt accumulates against asset values inflated by the debt itself. The interest rate environment that enabled the accumulation changes. Asset values fall. Concentrated loan books at regional institutions begin generating losses. Depositor confidence at those institutions erodes. The most mobile depositors move first. Their movement accelerates the erosion of confidence for everyone else. The sequence accelerates. What is different in 2026 is not the pattern. What is different is the legal architecture that was built specifically to manage this sequence once it becomes visible. The 7-day clause. The bail-in framework across 24 jurisdictions. The Orderly Liquidation Authority under Dodd-Frank. This architecture was constructed after 2008 by regulators who had watched the same sequence play out and decided that the next time it happened, depositors above the insured threshold would absorb losses that previously fell on taxpayers. That is not a sinister conspiracy. It is a deliberate policy choice, made in public, documented in legislation, and it has been in place for 15 years. Most depositors simply have not read the documentation. Here is what the practical implications are, stated as a framework rather than instructions. Understanding your actual coverage is the starting point. If you hold more than $250,000 at a single institution, the excess is uninsured regardless of the institution's apparent stability. The FDIC's institutional lookup tools are public and free, spreading deposits across multiple FDIC-insured institutions to remain within the insurance limit at each is straightforward. Understanding that joint accounts and retirement accounts have separate coverage calculations is part of that picture. Understanding what physical assets outside the banking system represent in this context is the second consideration. Gold and silver held in physical form in your possession, or in allocated segregated private storage that sits outside the banking system, are not subject to the 7-day clause. They are not subject to orderly liquidation authority. They are not part of any institution's liability structure. They sit entirely outside the claims hierarchy that governs everything else described in this video. Central banks globally purchased record quantities of gold in 2024 and continued accumulating through 2025. China, Russia, India, and sovereign wealth funds across the Middle East have been systematically building gold reserves. These are institutions with the analytical resources and regulatory access to understand exactly what is on the balance sheets of the Western banking system. They are not buying gold because they expect a collapse next week. They are buying gold because they are managing against the tail risk of a system that their own analysis tells them is under structural stress. They are doing exactly what the legal architecture of the system suggests is rational for any creditor who wants assets that cannot be converted or delayed. Silver, trading at a significant discount to its historical ratio relative to gold, faces additional supply constraints from industrial demand in solar manufacturing, electric vehicles, and defense applications. Physical silver demand has been exceeding annual mine supply, and above-ground inventories are at multi-decade lows. The monetary case and the industrial supply case are both present simultaneously, which is an unusual combination. The third consideration is timing and optionality. The decisions above, reviewing your deposit coverage, understanding the legal architecture of your accounts, establishing a position in assets outside the system, do not require an active crisis to justify. They require only an accurate understanding of the structure you are currently inside, and they become materially harder to execute once a confidence event is underway at a specific institution. Because by then the sequence is in motion, the queue is forming, and the 7-day clock may already be running. Here is where we are, stated with the precision the available data permits. Bank balance sheets in the United States carry close to $500 billion in unrealized securities losses, based on the most recently published figures, representing approximately 20% of aggregate banking system equity. Commercial real estate office delinquencies are approaching 2008 peak levels at the fastest rate of increase ever recorded in this data series. Regional banks hold nearly half their loan books in commercial real estate. Latent distress in that sector is estimated to be 4 times larger than formal delinquency statistics currently reflect. The FDIC Deposit Insurance Fund has a 1.40% reserve ratio, above the statutory minimum but not sized for a systemic event. The bail-in framework is legally active across all major Western economies. The 7-day notice clause is sitting in your savings account agreement right now, available to be invoked without external authorization, without a public announcement, and without any headline to warn you it is coming. What is not yet determined is the specific trigger. It is not known which institution, which earnings report, which commercial real estate maturity default, or which external shock will convert this latent stress into a visible sequence. A Stanford finance professor who studies bank fragility stated it directly in May 2025. The ingredients for stress are still present, especially if macroeconomic conditions deteriorate. He is describing a system that is loaded, not one that is discharged. But a loaded system and an unloaded system require different responses from the people inside it. The investors and depositors who came through the banking panics of the 1930s, the savings and loan failures of the 1980s, the financial crisis of 2008, and the regional bank failures of 2023 were not the people who moved the fastest after the headline appeared. They were the people who understood the structure before the event, who read the actual account agreements, who recognized that a quiet clause buried in a regulatory definition is not a footnote. It is a feature that was deliberately designed and can be deliberately used. Your savings account is not a vault. Your deposit is a liability on a balance sheet. The insurance protecting it has a cap and a fund with quantifiable limits. The legal framework governing what happens if the institution holding your deposit encounters stress has been redesigned since 2008 to protect the system first and the depositor second in that order by explicit statutory design. This is not the end of the sequence. The next data points will arrive in the coming weeks and months. I will be tracking the FDIC quarterly banking profile when it publishes. I will be tracking commercial real estate maturity data, regional bank earnings disclosures, Federal Reserve balance sheet reporting, and any regulatory filings that indicate specific institutions are approaching the stress thresholds discussed today. Because the sequence described in this video does not resolve in a single news cycle, it develops over months. Each stage will be visible if you know what you are looking at. Stay with this channel because the next development in this sequence is not a prediction. It is a disclosure that has already been made somewhere, in a call report, in a regulatory filing, in a quarterly earnings footnote that has not yet become a headline. The job of this channel is to find it before the headline does. The only question that remains is whether you are watching this unfold from inside the system without understanding the rules, or from a position you chose deliberately because you read the fine print. Let me add one more layer that most financial commentary skips entirely because it is the layer that explains why this time the sequence cannot be resolved the way it was resolved before. In every previous banking crisis, there was a backstop of last resort. In 1933, it was the creation of the FDIC itself. In the savings and loan crisis, it was the Resolution Trust Corporation funded by federal appropriations. In 2008, it was the Troubled Asset Relief Program, $700 billion in congressional authorization, combined with the Federal Reserve expanding its balance sheet from under $1 trillion to nearly $3 trillion in a matter of months. In 2020, it was a combination of zero interest rates, $4 trillion in new Federal Reserve asset purchases, and direct fiscal transfers to households and businesses at a scale not seen since World War II. Each of those interventions worked because the conditions for them existed. The fiscal capacity was available, the political consensus for intervention was achievable, and the starting point before the crisis meant that the monetary and fiscal tools had room to operate. The starting point today is different in a specific and measurable way. The United States federal debt stands above $36 trillion as of early 2026. The interest payments on that debt are running at an annualized rate that exceeds the entire defense budget. The Federal Reserve's balance sheet, even after the quantitative tightening that began in 2022, remains over $7 trillion. The Fed funds rate has been held at 3.5 to 3.75% as of the January 2026 FOMC meeting, with inflation described in the Fed's own statement as remaining somewhat elevated. What this means is that the tools available in 2008 and 2020 have limited room to operate today. Cutting rates to zero again would require the Fed to accept that inflation, which is already elevated, will rise further. Expanding the Fed's balance sheet through new asset purchases would add to a balance sheet that is already historically unprecedented in size. And congressional authorization for another TARP-style program would require bipartisan political consensus on fiscal spending, in an environment where the national debt and its interest costs are already a primary policy concern. This is not a prediction that the tools will not be used. Central banks have repeatedly demonstrated a willingness to expand their intervention toolkit when the system is under sufficient stress, but the starting conditions determine the cost of the intervention. And the cost today is higher than it has been in any previous crisis, which means the resolution is either more expensive, more inflationary, or requires a mechanism that does not add to the government's balance sheet. The bail-in framework is that mechanism. It is resolution without new taxpayer money. It is recapitalization using the bank's own liability structure, meaning the deposits, bonds, and equity that are already on the balance sheet. It does not require congressional authorization. It does not require the Federal Reserve to print new money. It requires only that the FDIC invoke its existing legal authority under Title II of Dodd-Frank. This is why the architecture matters, not because it will necessarily be used, but because it exists. It is the lowest cost option for resolving a systemic banking stress from the government's perspective. And the constraints on every alternative option are higher today than they have been at any previous decision point. The depositor who understands this is not a pessimist. The depositor who understands this is operating with accurate information about the structure of the system they are inside. And accurate information acted on before the sequence becomes a public event is the only form of protection that the architecture itself cannot override. That is where this video ends. Not with a prediction, not with a timeline, with an accurate description of a structure that most depositors do not know exists, built on documented data that is publicly available, and governed by laws that have been on the books for 15 years. The sequence has a beginning. It does not yet have an end. Watch this channel for the next development.